ask yourself, challenge yourself, is there a way to be more disruptive, to take more pain and inefficiency out of the system, to disintermediate the middlemen? What does that represent? What does that first principles thinking represent? And is that possible?
You're listening to the Startup Podcast. This is an educational episode, in-depth masterclasses about the concepts essential to building, running, and investing in Silicon Valley-style startups. Whether you're a founder, investor, or operator in a startup, you'll gain insights into the principles that power high-growth disruption the same way Facebook, Google, and Uber do it. The conversation starts now.
Hey, I'm Chris Saad.
And I'm Yaniv Bernstein.
And on today's show, we're going to discuss why big companies, incumbent companies, often fail to compete with and handle disruption from startups. As the environment changes, as there's new regulation, new cultural norms, new technologies, these big companies are often very slow to adapt, very slow to commercialize new changes, and can actually get disrupted by small companies. So if you're a founder, how can you take advantage of that? And if you're in a large company, how can you avoid that disruption and act with a little bit more agility and respond to change? All that and more on this week's Startup Podcast. Stay tuned.
This episode of the Startup Podcast is brought to you by Vanta. I get it. You hear security and compliance and you think time-consuming and stressful, but it's critical for scaling your business. Achieving compliance with ISO 27001, SOC 2, Essential 8, or other in-demand frameworks can unlock major growth for your company, help you sell to the enterprise, and establish customer trust. And with Vanta, you can get compliant in weeks instead of months and save up to 85% of associated costs. And just for TSP listeners, you can get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast. So before we get started, Chris, I'm not sure if you've noticed, but we're starting to be kind of a big deal on YouTube.
I noticed that we're getting lots of views. It's pretty exciting.
It's pretty exciting. So those of you who are regular listeners know that we have the Startup Podcast Pact. And this week, what I'd love to ask you to do is help us capitalize on our YouTube growth. And if you haven't done so already, head over to YouTube, find the Startup Podcast, and give us a follow there. YouTube is a very algorithmic platform, right? And I think the algorithm likes us right now. If we get a few more of our TSP listeners to follow us there, that's going to tell the algorithm that we're doing something right and will help YouTube help us find more founders who will enjoy this content.
And if you comment on the videos, we promise to engage with you there as well. So if you'd like to chat to Yaniv and I, we'll respond to every comment we can find on the YouTube videos. So join us there and let's discuss each episode and each clip as they come out.
You also get to see our beautiful faces there.
Oh God, we have a face for radio.
On with the show. So Chris, one of the things that happens quite often when someone starts a startup and they start talking to investors and the investors say, couldn't Google just do this and crush you? The answer nearly always is, well, have you seen Google? If they were going to do this thing, if they were going to crush you, they would have crushed you already. The truth is, big companies, despite having all the resources at their disposal, actually find it really difficult most of the time to compete with nimble startups. And what I thought would be good in this episode would be to break down all the different reasons why you shouldn't be scared of Google. There are a lot of things to be scared of. Google copying your idea is probably not one of them.
And Google, is probably the best case scenario, right? Because they're designed internally to have these kind of independent little startup scale squads that are trying to move relatively quickly, etc. It's even worse when you think about why can't legacy insurance company A go do the thing you're doing, or why legacy healthcare company B can't turn around and do the thing you're doing. And so, the question of today's episode is why do these young companies, these startup companies, these tech companies tend to have a meaningful advantage over legacy companies, large companies that seemingly have all of the advantages, and yet they're able to get disrupted or out-executed by some of these smaller players? You will often, as a founder, have this skepticism from your friends, from your family, from early dumb money, who'll go, well, I don't know, Chris, I think healthcare company B could probably go do this. Why wouldn't they just go do this? This is really about empowering founders to respond to that question, but also to free up potential founders to go, no, actually, that idea I have, maybe that is something that I should go pursue because these big legacy players are just not going to get it done. The reality is this is actually a multifaceted problem. So we're going to cover many of the facets that Yaniv, you and I have come up with just quickly here on the fly, including culture, domain dogma, business impact, business model, and also we're going to touch a little bit towards the end on if you're in one of these big companies or you're a leader in one of these big companies, maybe how you can get around this dilemma and maybe compete a little bit better in a way that's more disruptive and more startup-like.
So let's get into it. The first reason is culture. And so when we talk about culture of a big company, it is fundamentally different from a small company. What's that settler model where you've got like pioneers, settlers, and citizens or something like that, right? The idea of, you have these different waves of people with different predilections, right? You've got the people who want to discover new territory, and those are your 0 to 1 people. And then you have people who want to settle that new territory. And then there are people who just kind of like living where they are and, expanding and growing these things. And that very much applies to startups. And so when you're a big company, all of the people whose predilection is to be an explorer or to be a pioneer, well, they've been run out of town. They're no good there. So what you have left is the folks who like to be in a stable organization and like to incrementally improve it. And that is not, by the way, a diss on them. That is, for the most part, what they should be doing. But it's worth understanding that the people who are there are fundamentally different to the people who are at the startup. And that is by design and by necessity.
By definition, a large company will attract people who are comfortable in large companies. And those people tend to be, as you say, Yaniv, incrementalists. They tend to be people who like to manage within bureaucracies, who like to increase outcomes by single-digit percentage points, who are very comfortable with the well-worn territory, who are very good at participating in well-worn pathways. And so you tend, generally speaking, in the averages, your company, your large company, a large company is probably filled to the brim with these kinds of people. And as you said, that is not a slight on them. That's not pejorative. These are usually very, very good managers of large companies. And, they have a great skill set and they're doing a great job at managing that large company. They're also living within a large bureaucracy, which has certain processes, certain consensus building techniques, people they have to run things by, get sign off from. And all of those people have that kind of predilection to do incremental things. There's a whole ecosystem around them. And those people tend to be risk averse. They tend to have a certain outlook on risk, what their appetite for risk is and whether risk is fundamentally a good factor in the business or a bad factor in the business. So these are the kind of core facets of culture that can really get in the way of your company embracing disruption and doing 0 to 1 actions. Now, of course, there's also other things like you may not actually have the kind of people you need in the company, the kind of skill sets in the kind of roles you need. So if you're an insurance company or a healthcare company, you may not have, for example, the deep bench of engineering talent required to build ed tech or health tech, insure tech software. You just don't have that engineering team present. You don't have that engineering culture present. You have some IT department. You have some people who can write a little bit of code, but you don't have the people there who are designed to build hardcore production systems at scale. That's another area that you might bucket in people and culture that just gets in the way of making that kind of pivot.
Incentives at big companies are often aligned for this incremental improvement. What we're getting at here is that big companies are set up for incrementalism. And again, that is not a bad thing. In fact, that is, in a sense, what management of a good big business is. And so when you're a startup and you're competing against these big companies, yes, you do want to be thinking, okay, what is the culture? What are the incentives? What needs to work in this business, right? And then you can effectively change the field of play. This is like David and Goliath. These guys, they're mostly public companies. They are bound by quarterly earnings reports, analyst forecasts, sales team quotas. They are bound by their legal departments and HR policies. All of these things are there to say, okay, we're going to be growing our earnings quarter on quarter. These things work well to make sure that the typical increment from quarter to quarter is up and predictable. But what it also means is that when there is a shock, then things get very difficult. That's why when you are a small startup and you're in a space where there is a big company, you need to make sure that you are making use of your own strengths and their weaknesses. And then they will not come for you because they're not equipped to do so.
Just think about literally what these people are incentivized to do. They're incentivized to increase something by 1 or 2 or 3%. They're incentivized to reduce the cost of something by 1 or 2 or 3 or 5%. They're not incentivized to make some big, bold bet. And certainly their manager isn't, and certainly their manager's manager isn't. And so even if 1 or 2 of them would like to do that, the ecosystem around them will quickly put a kibosh on that as well. And then the other thing that's culturally embedded in these big companies is the pace of execution. So these shifts, these seismic shifts in business models, in regulatory environments, in technology environments, they tend to happen quickly, and capitalizing on them tends to require quick action. But the bureaucracy, the pace of execution, the cadence, just the way these big companies breathe tends to be way, way slower. And so they're going to end up paying just enormous amounts of opportunity cost. They just do not know how to move quick. So even if you're able to overcome the talent problem, even if you're able to overcome the bureaucracy problem a little bit, the risk aversion, you're able to hire an engineering team, you're able to adjust the incentives a little bit. Even after all of that, the general cadence of the company just tends to be a little slower. And so the culture and people aspect of a large company, a legacy company, makes it very hard to compete with smaller, more innovative, more disruptive startups.
I'm thinking of the fact that these companies are often referred to as dinosaurs. And that's, again, it's used pejoratively. But then I'm like, damn it, you've got a young kid. Young kids love dinosaurs. Dinosaurs dominated the planet for millions of years. They were fucking awesome. And they were very, very good at what they did. But they eventually went extinct because the circumstances around them changed. So when we refer to big companies as dinosaurs, it's not necessarily because we think they're bad. Again, dinosaurs are awesome, but be aware that they have, in a sense, become more fragile because they have adapted so successfully to the current environment that it makes it very difficult for them to adapt to a different one. And that, Chris, is your advantage as a startup.
Yaniv, I love the way you take these tried and true cliche references and actually look at them from a different angle, which is broader and more interesting. I think, people go, yeah, they're dinosaurs, which people just take to mean lumbering and slow and ancient and dead or deserve to die. You've done this multiple times where you take that metaphor and you go, but actually look at it another way. They are very successful, but their circumstances changed. And that is also true. Another reason why the analogy works. I love that very much. And yeah, I think that's right. They're dinosaurs in the worst possible way and in the best possible way. They're susceptible to the environmental shift the same way dinosaurs were. That's really, really great.
They're dinosaurs. You're a little rodent, early proto-mammal. So, what you need to do, and again, I always stretch these metaphors beyond their breaking point. You got to figure out what's the meteor that's coming and how do you use your superior adaptation to take on the dinosaurs.
So to summarize this culture section, the reason that your culture is probably working against you for innovation in a large company is there's probably no talent in the business or very little talent that likes to go from 0 to 1. They're really settlers. There's a lot of bureaucracy, a lot of risk aversion. You probably don't have the talent, the kind of talent you need in terms of engineering talent or design talent or product talent. The incentives tend to be all wrong. They're incentivizing incrementalism versus big bets. And the pace of execution, just the cadence of the company, tends to be too slow, and so they pay a lot of opportunity cost. So now the next facet of a large legacy company that makes it difficult for them to adapt and compete with disruptors is domain dogma. The people in the company and the principles and assumptions of the company are such that they believe that the way they do things is the way they've always been done and the way they're likely to always continue to be done. This is just the way stuff works. If you have a large healthcare company, they just well, let me tell you, Chris, we have to work with the regulators and we have to work with the vendors and we have to work with the hospitals, and this is just the way they work. And changing that is difficult or impossible. We have a unique set of relationships and pathways that are calcified. We are unbeatable, undisruptible. This is just the hard reality. And the people there tend to be experts at that reality, right? So they think about the world from that reality. And it's difficult really for anybody, but especially people in this environment to go, you know what? What if we think about this from first principles? The regulation has shifted, the technology has shifted, the cultural norms have shifted, or one or all of those things are true. If we were to rewrite this from a blank piece of paper, what could be true now? That is first principles thinking. That's the definition of it. And first principles thinking is an anathema to domain dogma. And domain dogma is typically deeply entrenched in legacy companies with legacy momentum.
I think the underlying theme behind all these things sort of reveals itself, which is that the way big companies operate is effective when the environment is relatively stable. When things work a certain way, and that's how it is, then your approach to incrementalism, what Clay Christensen in The Innovator's Dilemma calls sustaining innovation, right? It's not that these companies can't innovate, but they're innovating in an incremental way to sustain their advantage. The slower execution, the risk aversion, the dogma, which another way of saying is deep institutional knowledge. Again, like with the dinosaurs, this is all context dependent. One person's domain dogma is another person's institutional knowledge. And the difference is it still adaptive or is it maladaptive? Have the circumstances around you changed or have they not? And again, we're talking to you, founders, people who work at early and mid-stage startups, right? And one of the things that makes tech so exciting is that it is a highly changeable, rapidly changing environment. That means that the incumbents have a difficult time dealing with it. Again, like you said, Chris, Google is the best case scenario, right? Like even Google, one of the Magnificent Seven, has trouble keeping up with the pace of change, as we've discussed in our recent Reacts episodes talking about AI. If you're a non-big tech legacy company, you're going to have even more trouble dealing with the pace of change that is implied by the tech world. And it speaks to the strategy that a startup should adopt. So this is a slight aside. We could probably do a whole episode on this, Chris, but you should never take on an incumbent in a full frontal attack. I wrote a LinkedIn post a couple of weeks ago about, sometimes you see these pitch decks and they're like, so Salesforce sucks and it's really expensive. So our business model is we're going to make something that's like Salesforce, but it's cheaper and doesn't suck. And I'm like, how are you going to do that, right? Like you haven't talked about some technological shift, some change in the world that will allow you to work through and take advantage of the dinosaur-like nature of Salesforce. You're just saying, we're going to take them on, and that doesn't work. So you always need to be thinking, what is that disruptive innovation? What is that change in the world that you can take advantage of much more than the big company? And then how can I wield that to build something that cannot elicit an effective competitive response from those big companies?
I alluded to this earlier, but let me put a fine point on it. You're right, Yaniv. Dogma is useful and could be called institutional knowledge in a stable environment. And if the environment changes, then dogma or institutional knowledge becomes unhelpful or maladaptive. We've mentioned this in previous episodes, and I've alluded to it here. What changes? Typically, it's one of those three things that I mentioned. The culture shifts. So it used to be that you don't get into cars with strangers. People are now happy to trust the internet and get into cars with strangers. They're happy to go into other people's homes, let strangers into their homes. They're happy to meet people off the internet. The culture changed. The other thing that can change is the technology changes, right? We just moved from not having AI to having large language models and generative AI. So that's a massive technology shift. Before it was the iPhone, before it was the web. And so some fundamental technology shift occurs. And then the third major shift that often tends to happen is a regulatory change, where a regulation changes that was blocking something is now unblocked. A gap occurs that you can start to go into. Those tend to be the three major things that are so fundamental that big waves of changes occur. A Cambrian explosion of new companies and new opportunities open up. There are others and there are more subtle things that go on, but those are the major ones.
This stuff can take a long time to roll through. Like we talked about the computer revolution and then the internet revolution, the mobile revolution, the AI revolution. Well, these things, they're not in the past, right? There are big companies there that are still working through the mobile revolution. There are big companies out there that are still working through the internet revolution. The technology moves very quickly, but the impact of one of these big shifts takes decades to work its way through the system. And during all of those decades, there are opportunities for startups to disrupt the incumbents.
Yeah, that's absolutely true. Although what seems to be happening now, there's this concept of the singularity where the rate of change itself is increasing, and therefore the rate of adaptation to the change must also necessarily increase. And still, these large companies, because of their size, because of their momentum, because of their dominance, they have more time to adapt. They also have a balance sheet where they can acquire quick adapters, but they don't have infinite time. And your startup has space and room to get in there and be the first to win or take advantage of that adaptation or that change in the environment.
Just thinking about Salesforce itself, yes, now it sucks and everybody hates it. It's the ultimate in big enterprise software. How did they get a foothold? They were the first online, cloud-based, SaaS-based CRM. So they didn't take on the existing big players head on. They leveraged a new technology to do it. So if you are going to take on Salesforce, you've got to do the same damn thing. Otherwise, you will be crushed.
Actually, I don't know if they were the first, Yaniv. I actually built a web-based CRM the same year Salesforce was invented. And I was like, you know what? Why don't we just deliver software through the web? I had this thought. I built a web-based CRM.
So I say this with love. Nobody cares. You didn't build sales.
No, that's right. It's that saying from the movie, if you'd invented Facebook, you would have invented Facebook. This is an instructive lesson though, right? It's not just about seeing the opportunity and building a thing. It's what I've often talked about is it's first to scale wins. And so it's not just a matter of identifying and capturing the trend. You actually have to build an incredible business around it too.
Companies like Atlassian, Quora, and 7,000 others use Vanta to build trust and prove security in real time. Automate compliance and start scaling your business today. Get $1,000 off Vanta when you go to vanta.com/TSP. That's VANTA.com/TSP for the Startup Podcast.
So the next category is somewhat related. These are all building on each other, and it's related to business impact. And this is where the term innovator's dilemma is typically applied around business model and business impact. So you may have maybe gotten through the dogma. You may have recognized the opportunity in your big company. You may have even changed your culture and so on. But then you have to hit the hard reality of like, hang on a second. If you launch this new marketplace or you launch this new technology, it may upset our traditional customers and partners and vendors. You know, we're a big company, Chris, right? We're a healthcare company. We have all of these relationships with all of these vendors. And you're proposing to build a new marketplace that allows anyone and everyone to offer services into hospitals. Well, what about our incredible relationships with our incredible vendors? They're going to be really upset. You're going to cannibalize these relationships. You're going to jeopardize these relationships. We cannot do that. So that is one way that your existing business may actually reject change because the relationships that that business relies on cannot sustain the disruption, cannot tolerate the disruption.
Exactly right. There's not that willingness to do the damage. And, you know, I'll try not to get in the habit of quoting 20th century genocidal maniacs because Emil Michael doesn't like it. But Joseph Stalin once said, to make an omelet, you have to break a few eggs. And the truth is, if you're a big company, you don't want to break those eggs. You want to protect all those beautiful eggs. You don't have it in you, which is probably a good thing because Joseph Stalin was a sociopath. But it does slow you down. You've got infinite edge cases and corner cases and goodness knows what. Whereas a startup has a clean sheet. They can just do the thing. If you're a big company, in theory, you could do the thing, but you're going to piss a lot of people off. You're going to lose a lot of money. You're not going to hit your quarterly earnings. There's going to be a PR shitstorm. You don't have the stomach for that. So instead, you're just going to take another incremental step while you watch that meteor come towards the Earth.
Yeah, and you know, this reminds me, Yaniv, and probably everything we've been talking about applies here, of all of the maladaptive behavior we see in startups, where we've talked endlessly about this idea of don't prop up incumbents, reconsider if your business is really a B2B business or it should be B2C and you should be disrupting the customers you think you want. This is what we're talking about, right? Is like these companies, these large companies, they're afraid of disrupting the status quo. You can't be. You shouldn't be. And so when you're thinking about your business model, when you're thinking about your product, I find that a lot of founders tend to go to like, hey, how do we help the incumbents? How do we help the status quo? How do we add a little bit of optimization to what's happening already? There are plenty of big businesses that have been built that way, and that's a perfectly fine business to go do. But ask yourself, challenge yourself, is there a way to be more disruptive, to take more pain and inefficiency out of the system, to disintermediate the middlemen? What does that represent? What does that first principles thinking represent? And is that possible? And I always want to challenge the people I work with, you know, in my advisory work and on this podcast is like, yeah, you can build a great B2B SaaS business helping the incumbents do the thing they do a little bit more efficiently. But have you considered if you build a B2C business, how might you completely eliminate or disrupt a whole bunch of nonsense that's going on in the world from first principles? And that's something I think that's equally exciting, if not more exciting, for founders to consider.
Another point to consider here is that if you are building a technology that allows the incumbents to hang in there for a bit longer, we're making taxi companies more efficient. Someone's still going to come along and invent car sharing. And then when they do that, you will be crushed along with the taxi industry. So it's like, okay, you're taking a half measure. You are delaying the inevitable. You've made freaking sweaters for dinosaurs, but you're still going to die out when the dinosaurs do.
That's such a great point. And it's one we've made multiple times through the show, right? And Uber just continues to be the very best example of this. And the worst case of this, right, is when a founder comes to me and says, Chris, I dream of disrupting logistics and taxi, and I dream of making the rider experience better. And my product is building dispatch software for taxi companies and buses. And it's like, dude, you have a vision of eliminating pain and suffering and waste, but you're trying to convince the legacy incumbents that their business model is broken. Those two things are incongruent. One does not lead to the other. So yes, you can make a small business, a great business, a meaningful business from building some efficiency software. Yes, you can build an incredible Uber if you know how to operate well and disrupt the status quo. But no, do not dream of disrupting the status quo while also building tools for the incumbents. That is just, you're not understanding the game you're playing. Stop it. Please stop that.
I just want to touch on the more formal meaning of the innovator's dilemma, because it's sort of been lurking in the background here. And I think there's more to why these big companies can't compete with you than just the innovator's dilemma. But the innovator's dilemma is important because it comes from the development of what are called a disruptive innovation. What makes an innovation disruptive is that an existing large company cannot effectively incorporate it into their business model. And that's usually because the technology is inferior along some axis or has lower profit margins or something like that, right? So you've got like a new technology, and a classic example of this is Kodak. Kodak invented digital photography. But you know what? They were making so much money selling film and selling all the stuff to the network of developers. And they had like such incredible, insane distribution that they're like, if we focus on digital cameras, then we are going to completely neutralize our competitive advantage in film. Plus the technology is worse. It takes shitty photos. Like no serious photographer's ever going to use digital. I remember that argument even not that long ago. No serious photographer's ever going to use digital because it's worse. And it was worse. But the way of technology is it gets better, right? And so Kodak was sitting there having invented this technology. And again, this is why I want to say, big companies can innovate. The problem is they can't bring their innovations to market because of all these things, right? So Kodak invented digital photography, sat on it, going, you know what, there's no money in this. Let other people just take off these small, unprofitable niches that they didn't even notice were missing. Their revenue was growing. Everything was great. And then one day they woke up and the world had transitioned to digital photography and they missed the goddamn boat, right? That is a disruptive innovation. That is what you, as a small startup, want to be using against incumbents. Again, with mobile, and of course, the current wave is AI. What a great time to be a founder. The big companies are aware of it. And again, the big companies invented it. Who kind of invented the modern transformer AI? Well, it's largely Google, with big contributions from Facebook and a few others. And then OpenAI, which is, increasingly a big company now. And you wouldn't count them out, but it is so difficult. Why was Google caught flat-footed? Despite the fact they invented this stuff, is because they couldn't figure out a way to incorporate it into their business that didn't end up collapsing their business and collapsing a lot of their existing competitive advantages. And so organizationally, culturally, from an incentive point of view, it's much easier for these businesses to stick their heads in the sand until it's too late. Now, is it too late for Google? I don't know. But if you're a startup, the thing to think about is not to be an AI startup, but to think about how has AI changed the game in a way that I can build a product that a big company simply cannot respond to because it runs against their own interests and their own incentives in the short to medium term.
Kodak invented digital photography. Xerox PARC invented the GUI, the Windows, the mouse, word processing, fonts. Google invented transformers. I'm pretty sure taxi companies had apps to order a taxi. In fact, I was using one called Taxi Magic in Silicon Valley before Lyft came along. I think you're absolutely right there, Yaniv, which is, it's not that big companies can't invent things, but they seem to fail to commercialize them at scale because of all the things we've been talking about, but especially because of this section we're talking about here, which is the business impact section, which is, well, we can't disrupt our traditional relationships. And then the other two subtopics we wanted to talk about here is like, well, we don't want to cannibalize our existing business. The margins here are less. We can't have a whole business around film, to use the Kodak example. And then the other thing they don't want to do is they don't want to do things that seem incrementally small compared to their main business, right? Like anything new at first begins very small. If an executive or an operator in this large company comes along and goes, hey, this digital photography thing is huge. It's going to be awesome. You could easily imagine an executive saying, that's not huge. The pixel count is crap. The resolution is crap. This is a very small hobby market. No serious photographer is going to use this. It's a very small thing. It'll never be big as film. And we don't want to waste our time with this small thing. It's a nothing thing. And what's happening there is that these people don't understand exponentials. They don't understand the exponential rate of improvement of the technology, and they don't understand the exponential rate of increase in potential revenue and market opportunity. Exponentials, by their nature, are very, very hard for human beings to understand. We don't encounter a lot of exponentials in our day-to-day life.
And if we do, they kill us really quickly.
They kill you really quickly.
Before you can learn.
There's that old saying, like, would you take $1 million or would you take a penny doubling every day? You take that penny doubling every day of the week. It is going to turn into millions and millions and millions of dollars. And just people don't understand it. They do not understand it. Most of the commentary you see on AI is like, oh yeah, but it doesn't do X. Or, oh yeah, but it'll never do Y.
I've got a terrible joke for you, Chris.
Yeah.
Why is the Irish economy doing so well?
Why?
Because their capital's always Dublin.
Fantastic.
Okay, carry on.
I like that. Let's wrap this section up then. So just to summarize, large companies find it difficult to adapt to new innovation and be disruptors. They don't like disrupting their traditional relationships and upsetting the market. They think that these things start off being small or not being very interesting, and they're not accounting for exponentials. And they don't want to cannibalize their existing business and their existing lines of revenue. That's all the kind of the business impact reasons that are holding them back.
By the way, just a very quick story. When I worked at Google, I was on the Google Maps enterprise team, which was like commercializing the Google Maps APIs and other Maps data. And we were earning about $450-500 million a year in revenue at very high margin, basically pure profit. And we were told that if we couldn't come up with a clear roadmap to $1 billion, we were going to shut the thing down. So these are some of the headwinds that being at a massive company face. Nothing seems worth it. And so it can really stifle innovation in that way.
So the next major reason or category of reasons that large companies tend to digest innovation and disruption slowly is business model. This is a little different than business impact. The first one is they want to avoid negative impacts and they don't perceive the innovation to be that impactful on their business. This is that their entire model of their business is set up wrong. So to go back to the Uber example, taxi companies were set up to have a model where they would buy cars. They would spend hundreds of thousands of dollars fitting the cars out with cages and signage and these proprietary dispatch systems and metering systems and so on. They would vet and hire drivers. They would put them on a staff, on a payroll, and they would dispatch to them through a manual dispatch system. That's the business model. That was the way the business was structured. So the idea that you go to these guys and go, oh, screw all that, just use everyday cars, use an iPhone, get everyday drivers, lightly vet the drivers in the cars and let people order cars from each other. That's like a brain-breaking model change, a completely different asset profile, a completely different vetting profile, a completely different trust profile. It is a different business model. And so that's why you'll see like these taxi companies, they launched an app because they thought Uber was an app. That's the innovation, is an app. People like to order rides from apps. It's like, that's not the Uber innovation. It's not the app. It's the model. It is the asset-free or asset-light, elastic demand supply curve. And you just can't do that as a taxi with scarcity and medallions and so on. And so there was never any chance for a taxi app to compete with the Uber app because the business model was fundamentally different. The final point to make there is it's just really, really hard as a large incumbent company to change your business model. Investors and employees and the finance people, they just don't want you to do that. So that's really, really difficult. So this has, been a lot of doom and gloom. If you're in a large company, you're an operator of a large company or leader of a large company, we've just told you all the reasons you're destined to die like the dinosaurs. And if you're in a startup, we've told you all the reasons why there's an opportunity for you, an opening for you to take advantage of changing regulations and cultural norms and technology. But what we want to do also here towards the end of the episode is talk about how a large company might adapt and really create opportunities for them to adapt to disruption and to act a little bit more with agility, a little bit more like these startup disruptors.
I would have to say, Chris, none of these are particularly effective to continue with the doom and gloom theme, but these are some things you can try. The first three of these are all, in a sense, the same. We're talking about having an innovation team, having a venture arm, or having an incubator. And it's really about having some portion of the organization that is kind of ring-fenced from the culture and the business model and all of these other things. It's like saying, okay, we're going to create a little free economic zone where harsh rules don't apply and you can frolic freely and, ideally use the resources of the business, but not be held back by the rules and policies and cultures and procedures and all of those other things. We can kind of deal with these separately, but I think it all comes down to the same thing, which is how do we create a part of this company that's not really the company? And I think that's a very hard thing to pull off.
I think they're all related, but I think they're very different models of behavior and they produce meaningfully different outcomes. So let's just rattle off the first three here. There's a fourth one as well, which we'll touch on soon. There's build an innovation team internally, build a venture group, and or build an incubator. I'm usually anti-innovation team if you are a young startup or scale-up. The whole company should be innovating all the time. And so to have a kind of a small innovation team, skunkworks team, creates all sorts of unintended consequences and aberrant behavior, and the whole company should be innovating. But if you're a large company with all of the problems we've just gone through, an innovation team may be one of the only ways to get around these things. Now, the problem though is a lot of companies set up these innovation teams, but they become places where ideas go to die. And they die for two reasons. Sometimes the innovation team is tasked with accepting new ideas from the mainstream company, and they're tasked with vetting these ideas and validating these ideas and killing them on the vine or pursuing them. And the little exposure I've had to this, that innovation team was really a catch and kill team. They would catch ideas, vet them, find a reason why they weren't good enough and kill them pretty damn quickly. And that was just like a complete waste of time. So make sure your innovation team is not a catch and kill team. And then the other reason that these innovation teams tend to fail is because they might come up with an innovation, but the innovation doesn't get grafted onto the company, onto the main company, and it doesn't touch the main customers and the main through line, the main momentum of the business.
That's exactly right. And we were talking before, Chris, about, Xerox PARC or about, Google and Transformers or Kodak and digital photography. Microsoft Research back in the day was also a terrible one for this. They would come up with these great innovations, but we were talking about the innovator's dilemma. The problem isn't that the big companies can't innovate, it's that they cannot deploy those innovations. And an innovation team, in a vast majority of cases, does nothing to solve that. So this is just where, great ideas come up and then slowly die.
Absolutely. As you said at the beginning here, these are low probability strategies, but they're strategies nonetheless that you need to try. What you need to do is make sure your innovation team is not a catch and kill team and is also not a team that is coming up with radical ideas that have nothing to do with your core business, and they don't have the authority to graft those things onto the core business. So you need to give them accountability, you need to give them authority, you need to give them space to seek and destroy inefficiency, waste, and pain from the organization. For my money, the best kind of innovation team is scouring the main business for pain and suffering and waste and building very pragmatic and tactical innovation to directly address that pain and efficiency and waste, and has the authority and the accountability to deploy that change into the business rapidly. And so the CEO, the executive team, needs to empower this innovation team with a great deal of accountability and autonomy. That's the only way it's going to work.
Yep.
The next idea is the venture arm, which is really a small team. It's a venture capital firm that's built into the business that is out there seeking innovation. It invests in that innovation, is able to be the first customer of that innovation, is able to get line of sight and visibility into those startups, and is able to make decisions about doubling down on those investments, buying or becoming a customer of those startups, and otherwise, having a taste, getting their beak wet on the innovation that's occurring outside of the business. That's very useful. It helps with the balance sheet. It helps with the valuations, the same way Microsoft invested in OpenAI, and now they're benefiting from all of the capital increase of OpenAI to a degree, because OpenAI has a weird structure. And so that's definitely a way to go. And then there's the incubator model where the venture team, the innovation team, has an ability to spin up independent businesses, where they have an ability to kind of incubate their own ideas that are maybe not born from the pain of the core company, but are worthwhile independent ideas in the same category or in the same space. And having a relationship with the core company, it maybe gives them some unfair advantage in terms of data or distribution or otherwise.
So then I guess the way, Chris, that I think is most promising of how does a big company deal with this is through acquisition. What we say is acquire fast and integrate well. Now, big companies are very good at the acquisition part, which means paying money to buy companies. They are much worse at the integration part, right? So the truth is most acquisitions go nowhere, because if you buy an innovative company and then you're like, oh, okay, now we're just going to crush you with the same bureaucracy, risk aversion, slow execution, innovator's dilemma as the rest of the organization, they will die and you will have wasted your money. But there are some companies who sometimes acquire fast and integrate well. And then they can get all of the benefit of that company. They can get some synergies, but they allow that innovative, disruptive company to do its thing. And I'd be interested in your thoughts, Chris, but my feeling is normally integrating well, there are exceptions, means integrating minimally and integrating slowly. You don't want to smother your acquisition to death. You want to let it do its thing. But now it belongs to you.
Yeah, look, it suffers from all of the same risks, right? If you acquire a great company and you let them do their thing, they're not improving your core business. They're not actually helping you innovate. They're just this thing on the side that may or may not succeed.
But it belongs to you.
Yeah, it belongs to you and your valuation, but it doesn't supercharge the core company's core business. And so if you integrate them slowly, or you don't give them the authority to integrate well, these people are going to quickly leave. They're the 0 to 1 people, and they're just going to rest, invest, and leave.
Yep.
To my mind, actually the only way to solve for this is to have a CEO and a leadership team who believe in it, who are willing to take risks, and are willing to make meaningful change. As far as I'm concerned, if you are one of these senior leaders or you report to one of them, please send them this podcast. You must recognize that the pace of change is accelerating, and the period through which your dinosaur will survive a changing environment is shrinking. And the reality that all companies in all categories must evolve to be software companies and AI companies, at least 50%, right? So Uber was a 50% software company, 50% logistics company. Apple is 50% humanities company, creative company, 50% technology company. Facebook is 50% social company, 50% software company. Whatever category your business is in, you need to be 50% that and 50% software company and AI company. And if you are a bold leader who is interested in making a meaningful impact on that business, you just have to recognize the reality of that pace of change is accelerating and the nature of businesses is changed. And I really, for my money, bring in someone or someones who you believe in, who can help you change the principles, the cultures, the way of working, the cadence, your values, your incentives, your org structure. Yet this all sounds like nightmarishly, idealistically impossible, but it's not. It takes a decision, it takes boldness, and it takes political will. And if you're able to do it, even half do it, you're able then to really, truly acquire fast and integrate well, to set up a great incubator that can build things that your company can digest, to have a venture firm that invests in things that you might ultimately become a customer of, to have an innovation team that actually rolls out innovation. I really think it comes down to the boldness of the leadership to make some change to that culture and that org structure so that that ability to digest disruption is increased to some degree.
Amen. All right, Chris, I think that's the pod. So, Chris, we've talked a lot about why you shouldn't worry about big companies, but also about the sort of strategy you need to adopt so you can effectively leverage the weaknesses of the big company to help you grow your startup and be uncompetitive with. So, if you need help improving your strategy and really understanding your way into the market, Chris, this is the sort of thing I know you love to do. So how can folks work with you?
Yeah, that's right. And it's definitely helping founders, think about disrupting these incumbents is something that's a passion of mine. But more recently, I've been equally passionate about helping these larger companies adapt to disruption. I've recently just been helping a publicly listed company do the kind of transformation I just described. And I want to give, max credit to the CEO who was bold in this way, who heard what I had to say and go, yes, that's the path. Let's do that. And he, changed the culture. He managed the board. He implemented the change and ripped the Band-Aid off. And that was incredibly exciting. It's something I'd like to do more of. And so, yeah, if you'd like to work together both as a startup disrupting incumbents or as an incumbent trying to avoid disruption, learn more about what I do over at chrissaad.com/advisory. Yaniv, how about you? How can people find you on the internet?
I do most of my stuff on LinkedIn. I post about startups, I post about leadership, I post about business and anything else that's of interest to me. So give me a connection there. If you let me know in the intro that you're a TSP fan, I will accept your connection. And for some of the stuff that's not appropriate for LinkedIn, I post that on X instead. So you can follow me there on @YBernstein.
All right, awesome, Yaniv. That was a great one as always. We'll catch you in the next one.
Yep, see you then, Chris. Today's episode of the Startup Podcast was brought to you by Vanta. To sell to the enterprise, proving security is essential. Vanta allows you to breeze your way through to SOC 2, ISO 27001, or Essential 8 compliance and unlock major growth for your company. Go to vanta.com/TSP today. That's VANTA.com/TSP for the Startup Podcast to claim your $1,000 off.